Hey, Arjun, thanks so much for joining me for this and
Having me, buddy.
for,
I appreciate it.
of course, yeah. So, obviously, as everybody knows, right now it is Monday, April 6th, and so we are still in the Bay Area and all over the nation, pretty much sheltered in place, and unprecedented times. Never have I or anybody that I've talked to has been through anything like this, especially in the United States. So I was just going to ask you because you are in the thick of things. You are a mortgage lender and you do a lot of business and you've continued to do a lot of business. So wanted to ask you kind of on a micro level what you're seeing uh, in your day to day. So I have a couple of questions written down and just take your time. Feel free to answer them. Let's just chat about it. So, for example, one of the things that I wrote down and that I've been seeing in headlines and with through emails and other people that I've been speaking with
Hmm.
is that it sounds like right now lending guidelines among banks and mortgagers and mortgage companies have gotten a lot stricter. Can you speak about that a little bit? Is it harder right now to get a loan than it was 2 months ago?
Yeah, it definitely is. But that's not to necessarily discourage people from even wanting to try. Just a lot of banks and investors, their risk appetite is now decreasing, of course, because this isn't 2008. A lot of the measures that banks and investors are taking are to prevent another 2008. Last time around, for those of us that were in real estate or in lending at the time, 2008 kind of hit, and I mean, the rug got pulled out from underneath everybody, but it was as a result of a lot of investors and banks completely caving in. So it's not like they were exiting the market, they were forced out. I mean, because they went insolvent, they had so many defaults on their books, non-performing assets. So it that caused and reaped all the havoc. Whereas now a lot of these investors and banks are seeing this, and there's more that goes into it in terms of what caused them to take a little bit of a step back or become really cautious. But they're seeing talk of potential unemployment eclipsing the rate that it was during 2008. 2008 unemployment hit a max of roughly around 10%. Real unemployment was maybe a little bit higher than that, but by and large, the main headlines read 10%. You're talking now 20%. Some analysts and economists are saying on a conservative level, and it could be even higher than that. So when you see that coupled with the mounting, all the job losses, you're talking about 10 million jobs that have been lost. Companies are potentially going to change in so many ways in how they do business, along with a number of other guidelines. Banks are just seeing that and saying, okay, we're going to take a big step back. So non-QM lenders, which is a non-qualified mortgage, and that's your more creative loan products. Anything that's not securitized, bank statement loans, 10% jumbo loans, lending off of 1 year's tax returns. Those are all gone. They vanished like fast. They pulled out in a matter of a day. Not because those banks went out of business again. They hope to return maybe in Q4. So that's the encouraging thing. But they're taking a big step back and saying, look, we don't want any more exposure. We don't want any of these deals to be stuck on our books because there isn't a market for banks to sell those loans and move them. Now, the agency side of things, which, they kind of shifted back to more optimistic news, anything that's securitized by Fannie and Freddie, which are going to be conforming or high limit conforming deals, the market is still fluid for those loans because there's a
That is 736,000 loan amount, or what is that? What is the number there?
the high limit conforming rate was just raised to 765 for a high limit market like we are here in the Bay Area.
That's mortgage amount, right?
Mortgage amount. So as an example, if you bought $1 million place, but you put down enough to get yourself into a high limit conforming loan, meaning $235,000 and such, that would get you to 765 if I did the math correctly.
You bought $1 million property and you put a little bit under 25% down, or right around 25% down. You're within that conforming amount, and that's also actually the max for the mortgage interest deduction that with the 2018 new tax
Correct.
plan that was created.
That's not to say that anyone who finances above that doesn't get any mortgage interest reduction. It's just up to the 750 mark. So
yeah, correct. Yeah.
For people, I mean, for everyone buying in that range, I'm glad you brought that up too, Joe. That's a great point because obviously, the three main benefits of of buying, which are appreciation, amortization, and tax benefit. Those three main areas. Two of the three are not going to change in this new market that we're morphing into, which is your tax advantage. That's going to stay the same unless they change the tax code, which there's no plans to, and amortization, meaning as you pay down the loan, you're going to continue to pay that down regardless of what's going on in the economy. So appreciation, of course, is what might fluctuate right now, right? Because we're heading into some uncharted territory. But going back to your question regarding loan products, so agency loans, and anything that's securitized by the government is, that market remains fluid. And yes, some guidelines are tightening, but it's just because banks, they're lending you a lot of money, right? At the end of the day. So they have the money to tell you, ask you for an additional piece of documentation or say that we want to see a little bit more in reserves because they're just weary, they're just cautious, and they don't want a repeat of what happened in 2008.
So as of today, it's April 6th. The average price in my city where I live is Belmont, California, a little city between in the mid-peninsula between San Mateo and San Carlos. Basically, if you're driving down Highway 101, you will pass the city in about 22 seconds. The average price here is about 1.8, 1.9 million or something last month. So somebody who's buying in that price range, let's say they were planning on putting about 25% down payment for, let's say, a $2 million house. Let's keep the math simple. So they were going to put about $500,000. Let's include closing costs in that, and needed a $1.5 million loan amount. How has that situation for them changed today versus 2 months ago? If they, let's say, saw a property, virtual tour, 3D virtual tour in Belmont, and they're like, hey, I want to write an offer on it. Let's make it contingent upon me seeing it after the shelter in place is lifted, or, with the proper precautions, which is still allowed, and close escrow on it. How has the loan situation changed for them from 2 months ago?
Well, it's tighter, that's for sure. There just may not be as much choice. That's not to say that you can't get a loan. So anyone who's shopping in a jumbo loan market shouldn't be like, there's nothing for me, I'm not going to be able to get a loan. That's not the case. If you are still able to substantiate your loan application by way of, showing good credit and that you've got a down payment and that you've got good reserves and your employment is stable, you're still going to be able to qualify for a jumbo loan. The choices and the options in terms of the overall strategy, whether you could put down a little bit less or how you could get creative with leveraging that property, that's what's changed. But the access to the money is still there, and you're still able to get a jumbo loan. You just may have fewer choices in terms of what banks are offering that. And the reason for that, again, is that a jumbo loan or a non-agency loan, that's going to be held on the bank's books. There isn't a secondary market for them to move and transfer those loans and reassign them. So if they're going to hold on to it, that's going to eat up, their ability to lend in the future, because it's money that they've lent out that they're now stuck with. So they're going to be very, very cautious in approving those loans, because it's like a marriage, right? If you're going to make that commitment, you better be pretty sure that you want to live with that person or be stuck with them for a long period of time, especially in a quarantine.
Especially with the uncertainty surrounding this. Like, we don't know, we don't know what's going to happen in 2 weeks. I mean, we're probably going to still be in a shelter in place, but what about round two? Or what about when the shelter in place is lifted and people back out talking again? Is there going to be a round two that, how does this virus, does it linger? Does it go down during summer and hot and humid weather, or is it going to stay around? There's so much uncertainty that we don't know how this is going to affect our economy long term, because even I guess the best case estimates that I'm seeing for when a vaccine will be available is like 1 to 2 years, right? Like an actual vaccine. Mm-hmm. Not to confuse it with, a lot of people are mentioning, there's these FDA approved drugs, malaria drugs and other drugs that are in the middle of FDA approval, and things that people are optimistic that are going to help cure this or whatever, or help relieve the symptoms or whatever. People are confusing that oftentimes with an actual vaccine. Right. Vaccine availability is 1 year to 2 years out, while these other drugs that are available now, people are optimistic could help this stuff. But right now we're at home, so obviously I have a lot of time on my hands, not showing properties because virtual property showings are a lot quicker and a lot less driving time. So I have a lot of time to research all these articles about what's happening with
That's,
Corona.
you know what though, I'll speak to that, Joe, because I think this is where people in your shoes become more valuable at a time like this. Like if you go online right now and you look on whether it's social media or just doing general searches about real estate, and some of us are being inundated by with these messages from agents, right? And I'm just using agents as an example right now, but they're saying, okay, I can still sell you a house, I can do a virtual tour, and it's still okay to buy. Like as a consumer, that's not necessarily addressing my fears. Like all I'm hearing in those kinds of messages, yeah, you still want to sell me a house, but I'm scared shitless because I don't know about my job. I don't know about this virus. I don't know what's going on. I don't know how that asset is going to perform. I don't know what I'm sinking my money into. None of those fears are being addressed. And what I appreciate about you is because you're really studious on the economics and you try and peel back some layers and you're telling people what it means. So you're analyzing what's going on and you're trying to look, I can sell you a house, but here's how I'm actually going to advise you on what's actually happening and what this information means to you. You know, I'm looking at the employment metrics and what I'm reading, and I'm consulting and collaborating, masterminding with guys who are smart too. And this is what that means for you, and that your money should be safe here. And you're advising people, you're not just selling. So I appreciate that about you, that you're reading and you're being studious about this stuff, as opposed to just saying, okay, well, I can still sell a house virtually, so let's buy, guys. You know, like don't back out of the market now, because all that tells a client who's already fearful, right? I mean, everyone's a little bit weary about what's going on. These are strange times. But all that's telling me as a client is that he just wants to sell me something, but he's not really offering any value. So I appreciate that, man, that you do that, because you and I have a lot of conversations about this stuff. So keep doing it, man.
Thank you, man. Yeah. Thank you for the kind words. I appreciate it. Yeah, I mean, yeah, everything that I'm reading, I do read a lot about like economics. I research companies' information, stock market, just everything. It all kind of interests me, and so what you see is all across the board. Like you see just, doom and gloom. This is going to be the next depression, worse, like it'll dwarf the 1932 depression, all the way up to, this is going to be nothing. We'll be back to normal, V-shaped recovery. And, usually based on my knowledge and my experience, it's somewhere in between there. But none of us have a crystal ball. There's nothing to predict. So, let's just do our best to know where we are, not think that things are going to be worse than where they are, or more optimistic than where they are. And everybody's situation is unique and different. We have a lot of people in our area that just have cash in the bank. Doesn't really affect them. What's going on here? And a lot of people who are not really at risk for losing their jobs. They're high-level employees of companies, and they're last in that chain of command to be let go. And they make $500,000 a year, and they're able to afford a house, and it's not going to have a huge effect on them long term. Then there's a lot of other people whose jobs are at risk. So it's really on a person-to-person basis of what people are comfortable doing. You just, my job is just kind of give them the truth, be transparent, and do my best to help them.
Keep it up, man.
Thank you. So we talked about jumbo loans. We talked about lending guidelines, things like that. So tell me a little bit about what your day-to-day looks like right now as a lender, as somebody who works with clients, works with banks, and facilitates mortgages, home purchases, and refinances. What does your day look like?
Yeah, so I mean, our work hasn't stopped. And it's if anything, it's as busy, if not busier than ever. I know some people, based on what's happened with this quarantining and shutdown and stay at home order, their work has stopped. They're going nuts. And I'm fortunate that well, you're staying busy, man. You just day to day has just changed. But for us, I mean, it's if the markets are open, then we're open. Logistically, we're a little bit challenged, and it's changed, because all of our, our processors are working from home. Our underwriters are logging in remotely. Our CEO is communicating with us from home as well. Like it's changed and it's different. The landscape is very different, but it's still pressing on. So, the mortgage market is still very, very active, and that means that we're very busy, which I'm grateful for, of course, but the work is a lot more It's a lot more focused because we have to be so strategic and really, really helpful. There's, you can't really be transactional because each situation is super different. And some of the day-to-day that we're actually doing, I've referred to this as people getting their financial house in order, so to speak. So, these types of shutdowns in the economy or slowdowns are a great reminder to people, sometimes more painful than others, as to what they should have been doing all along, whether it comes to saving or paying down debt or keeping things in order. So those people who have an asset, which is a house, and they've got equity in it, which everyone in the Bay Area does because we're sitting on over $1 trillion in equity just in the Bay Area alone. Forget about nationally. Now that hasn't changed yet, right? Employment numbers might be down, but people's equity positions by and large are not correcting at the velocity that the stock market was in decline or that the bond market was selling off at, what have you. So people need to keep that in mind and maintain some perspective. If you have a house and you had equity in it, your equity, it might correct a bit, and it likely will, only because of supply and demand. No other reason. Not because that house is actually not worth what you paid for it. Nothing like that. It's just supply and demand factors might have some impact on that. But if you have equity, this is a time, and I've been doing a lot of this, where we're helping people get their house in order. And what I mean by that is paying down debt, eliminating as much debt as possible. If you're foreshadowing or foreseeing that you could be potentially out of a job, your spouse could be potentially out of a job, or your job might change, your income might change, this is absolutely the time for you to get those debts in order and either wipe them out, pay them down, or figure out what you need to do to consolidate. The other thing is a lot of people have been taking their aggressive pay down strategy of maybe being in a 15 or a 20 year, and they're stretching it back out to a 30 because they need a little bit of a cushion. It's fine. You can always change it later, but look, I want to stay in this house. I want to lessen my expenses as much as possible, reduce them. So I had a 15-year payment, which is a lot more expensive. I've been in it for a couple of years. I want to shift back out to a 30 just to ride things out for the next few years or however long this might be. And then I can always pay ahead on it if I want to, or I can always restructure it back to a 15 or even a 10-year loan later. So they're trying to reduce their expenses that way. And then another thing is they're pulling out some cash to actually have a little bit of a nest egg. A lot of wealth advisors and financial advisors say that there's a magic number of either six months or so, that if you have 6 months of expenses saved up or you have it on the sidelines, that if everything came to a stop, and it's ironic because everything has come to a stop, that I could still maintain my, to a degree, my quality and standard of living and be able to pay my bills and not be completely freaked out. I've got a fallback plan. So this is a great reminder this time is for people to do that. So we've been doing a lot of loans where we're either consolidating debt, stretching out loan terms, or helping pull out a little bit of cash to keep on the sidelines to cover or in anticipation of a loss of income or a reduction in income. So those are the types of loans. And then on the purchase side, people are buying. I mean, it's changing, but there's a lot of opportunities out there. You're seeing it too, where now a great deal or some concessions might be struck with a seller because they have their circumstances, they need to move. And as a buyer, you want to get into that school district, or you wanted to move into that type of a house or what have you. Like, people's reasons to buy are still there, or reasons to sell. So that market remains active. It's just requiring a lot more information and a lot more back study as opposed to people just jumping in and doing it.
Okay, that's great. So to kind of clarify, basically your day-to-day is a lot of working with people, kind of being an advisor to them in a lot of ways as far as getting their financial house in order is, that could mean different refinance, a sort of cash out refinance, a restructuring of the loan some way,
Yeah.
just kind of advising them, helping with them with that. But also you are seeing purchases. Have purchases went down significantly, would you say, or is it around the same or more?
Well, there's two metrics.
2 months ago, let's say.
There's two metrics. The amount of purchases closing has slowed, but that is in large part due to the backlog of underwriting turn times, processing times, and escrow periods. Escrow periods got a little bit longer than in the last month for some people that got in a contract because they needed a little bit of extra time, or the sellers need time to set up their next move as well. So they wanted a longer escrow period or rent back. So we've seen a little bit of that in the way of slowing down the closings of purchase transactions. The data will come out probably in the next month or two, what March and what April really looked like in the way of purchase activity or closings. However, purchase applications are still up. I mean, we're still taking a number of purchase applications because people want to get approved. They want to get underwritten so that this is another way of getting your house in order. They want to be in a position ready to pull the trigger when the right opportunity comes up. That doesn't mean they need to buy tomorrow when they are going to be just as uncertain about the future as they are today. But they want to be ready in case a month from now, the right deal comes up, or 2 months from now, or whatever it might be. Maybe it's later in the year, towards the end of the year. So applications are still coming in at a fairly high intensity because there are people out there that are eager to just get themselves approved and just be in position to pull the trigger. They want to be armed. They want to be ready. And we're still seeing a high number of purchase applications come through the door.
One of the main things that's like in the news right now, or you're hearing a lot of people talking about, is forbearance or deferrals, deferment of payments, mortgage payments. What are you seeing banks doing? Like, what can you talk a little bit about that? What does that look like? A lot of people, I'm sure, that I know are out of work or got laid off. And it is affecting their ability to pay their mortgage at no fault of their own. This isn't something they could have controlled at all, any one of us. But we're all working together to stop the spread of the virus, and we're all kind of doing our part. But obviously, the federal government stepped in, it sounds like, and other banks and entities are working together with people. So doing things like forbearance, deferral, what do those things mean? What's happening right now? What are you seeing?
I'm glad you bring up this topic because there's a lot of misinformation about it.
Yeah.
In the media and amongst even banks. And then, of course, as it gets down to the consumer level, they're hearing different things. But they're all three different things. Forbearance, forgiveness, and deferral are three very different things. One is not the other. So forbearance is not deferral, and it's not forgiveness. There's been some misinformation out there that you can just get out of making some month's payments and it's okay. There's not going to be a hit. The bank's just going to kind of foot the bill for you and hold on to it. And this was well intentioned, and of course it's there to help. And I want to urge people that if you are going to pursue a forbearance, that you do so in an emergency type situation. You could absolutely not continue to afford your mortgage right now, and you need some relief, and that's why you need to do it. For those that are just doing it to just try and use it as a bit of a savings tactic, there's some repercussions you have to know about, and here they are. So when you have payment forbearance, you're essentially taking off 3 months. Let's say it's a 3-month period. You've got 3 months off, but at the end of those 3 months, those payments are due. So people are like, well, wait a second.
How's one lump sum?
That's the kicker there. It could be one lump sum. It depends on the servicer, and you'll probably be able to work this out as a consumer, as a mortgage payee. That you've got all that money that's due at the end of the 3-month period, as an example. So it might either be due in one lump sum, where they issue you a bill and say, here's 3 months worth of payment, which of course no one is going to be able to afford. Okay, we're talking like fractions of a percent of people would be able to afford that.
Yeah, how would that help you?
It doesn't help anything. It's just kicking the can down the road. Or they might say, okay, it's going to be spread out over the rest of the year, which means now your payment goes up by like $500 or $600, but you're back to making your normal payments. Or they're going to modify your loan. So one thing to bear in mind is these loan servicers have to report to the credit bureaus. So anybody saying that this is not going to impact your credit, there's no way that it cannot. So when they have to report each month an on time or a late payment, if there's no payment being recorded, that data is going to be reported back to the credit bureaus from the servicer, and you will take a hit on your credit. It is absolutely inevitable. So people thinking that it's not going to affect my credit, it will. That's why I'm saying you must be willing to go down this road if it is a kind of a last or worst case scenario or a last ditch effort to stay in your home. And we want everyone to stay in their home. We don't want people, and nobody has a reason to run from their home or bail on it the way it was happening in droves in 2008 because of the point that you and I talked about earlier. People are sitting on equity this time around, a lot of it. They're not going to leave that money on the table, and they still need a place to live, and the banks are willing to help. Last time the banks were very slow to react this way, which caused a lot of panic. So the intentions are good here by the banks and the federal government, is that we don't want to see an issue or a crisis come up, so let's allow this. But the unintended consequence is the misinformation and the impact that it's actually having on mortgage rates, which I can touch on here in just a quick second, is that so you've got forbearance. People need to understand that that money is going to be due in one way, shape, or form at the end, whether it's one lump sum, spread out over payments, or your loan has to get completely modified and recast. That's ultimately going to be up to each bank. So that's going to be a case-by-case basis. So people need to bear that in mind. But investors and banks, in what's going on with the interest rate market, they're seeing that. They're seeing potential unemployment rates being high. They're seeing what's going on with the economy. They're seeing forbearance offerings going out. And so they're adjusting rates because that is factoring into their risk tolerance. And that's what's causing mortgage rates to be all over the place and why they spiked in large part over these last couple of weeks because of the talk of forbearance and the talk of these other things.
So, okay, so that's forbearance. What is a deferral?
Deferral is just, I mean, the payments are actually it's just that. They're being deferred either till potentially a later time or written off. But there's no banks that I know of or investors that are out there that are actually deferring your payments or writing them off or, forgiving them. That's the same as forgiveness almost. So there's no payment forgiveness. It's forbearance is a very, very different term. So people just need to be aware of that when they're going into applying for these things and asking those questions, because when programs and things roll out really quick, nobody knows too much about what they're talking about. So if you're calling up the bank, and some people may have already found this, to ask about the program, they probably got very little information, or it might have been confusing because the people that are extending these programs, they're kind of learning on the fly. Everyone's learning as they go right now. But it's important for the consumer to know what the impacts are, what the implications are, and how this is either going to leave you in a better or worse position. If people have to do it, that's why this is there. It's there almost as as a backstop. Like, look, I don't have a choice. We cannot pay our mortgage right now. Absolutely not. But if you can pay your mortgage, I encourage everyone to continue paying your mortgage. Don't use that program or product until you're basically, left to it as a final resort, because you don't want the implications to your credit. And then of course this money's due, like we talked about. Oh, it's still due.
So one thing I want to touch on is to kind of go back about what you were talking about earlier a little bit and comparing it to 2008. So obviously 2008 was a housing crisis that created a recession, the Great Recession. And this time is different because it's obviously this virus that is causing a stop in the economy, causing a recession. What created the housing crisis in 2008 was a lot of 0% down, stated income, adjustable rate mortgage loans, meaning like I can make $35,000 a year. I can go to the bank and say, I want to buy this $850,000 house. They say, okay, great, 0% down. How much do you make? Well, I make $150,000. Okay, looks good. We're going to set you up with 4% interest. And then 2 years later, that jumps to 8.5%. That's kind of like what was happening. And then people couldn't pay. And then these might not be accurate numbers, so feel free to interrupt me. But
no, it's all right. Right context.
But that was basically what was happening a lot. And then, and then it was oversupply. People were building because everybody was just like, you can just keep building. You can just keep flipping. I heard stories. I know people personally who were like, yeah, I would just, buy a house and just sit on it because it's going to go up in value in a few months. And then you just flip it that way. So it wasn't real business. It was just kind of like going with the market, riding the tailwind or whatever it is of the market. And then the market said, hey, there's oversupply, supply and demand. There's oversupply and demand is low because nobody can afford houses anymore. And now we got to sell all these homes for a massive loss. And that caused a crash, and that's what caused everything. But this time is different because these last 10 years, they wanted your every piece of information, every transaction. I got a mortgage and they're like, hey, what was this $85 cash deposit into your bank 3.5 months ago? Or, or whatever, maybe they're, just things like that. So they're very strict. They've been very strict. Obviously I think I heard that people still do stated income loans and 0% down loans, but very rare. And adjustable rate, a lot of people back away from that anyway, even whether that's a smart move or not. People are just like, oh, that sounds bad, I won't do that. So a lot more 30-year fixed. So I think this time is different in that, a recession and people losing their jobs could definitely create more foreclosures and could definitely create a higher supply. But obviously it's not going to be anything close to what happened in 2008, just because people were qualified this time when they bought their homes. Am I right there? You have anything?
No, people are sitting on equity now. Like, they're not going to just walk away from it because they have skin in the game. To your point, they put down money, They had to qualify. The bank knew that based on what you were earning and how you were working and what your finances were like, that you can afford this mortgage. So they set in very, much stricter lending requirements and guidelines, and people were able to afford these things. So that's been in place, and that's definitely a big difference now than was 10 years ago. And you stated it correctly. The banking system or the lending system is what kind of caused the last collapse. Whereas right now, the financial systems might actually be what helps. They're going to be at the epicenter of this, and that might be what actually helps the crisis. If you see how much money is being pumped out, albeit, from the federal government, but lending is still going to go on. It's going to be a little bit tighter and stricter, but the banks aren't going to be out of money. There's not going to be a lack of cash out there. It's just going to be selective in terms of how it enters the market and how people can gain access to it. And they're going to have to prove hardship in some cases and actually, be fully approved and meet the requirements for getting capital, but it's still going to be out there. And that's what's going to be a big difference this time. But the equity positions that people have, if the average homeowner in the Bay Area was sitting on 15 to 30% of equity and 5%, let's say in the next quarter, is absorbed by just the market metrics, the nuance of supply and demand and what's happened, people are still sitting on equity. That's their money, that this asset has raised in value to give them. No one's going to be walking away from that. Even if they sell that home, they're still able to pull that money away. So this glut of inventory, like you talked about, that could potentially hit the market like it did in '08 because everyone was either bailing on a house or there was builders that overextended themselves. It's not the case now. People are still going to need housing. They're still going to need a place to live, or they're just going to continue living in where they're living. So there's going to be activity in this space. What the climate looks like is going to be, who knows? Nobody has a crystal ball because we need to see how things shake out. And we're obviously optimistic and hope for the best here that, the virus itself can be curbed as best as possible and contained. And once that happens, then we can start to figure out what this new reality is and how that's going to impact housing. But for now, this is not the same situation as '08, to your point.
That was going to be my next question about the crystal ball. What are your predictions? What do you see?
Oh, man. I definitely am not, nearly smart enough to be predicting anything, or at least putting it out there for people. I've just got my own personal feeling, and that is that I think it's, it all just really come down to the medical side of things. It's not going to be the federal government that can figure this out, or any one sector of the economy that's going to potentially be the savior of things. Right now, all the hope and inspiration and fingers are crossed is for the medical field, because the faster that any sort of treatment or antivirals or combinations of that can first be put in place, forget about the vaccine, as you said when we first started this conversation, is at least a year out. But the faster that at least some treatments can be put in place, the sooner that people can stop living in such fear that this virus is going to be a death sentence, or that it's going to be the end of the world. The loss of human life is already far too much, and it's, you can't put a price tag on it, and it's tragic. But the moment that some treatments get into place that can start to calm that a bit, and people say, okay, look, the virus is treatable. If something happens, there is medication that I can take. I'll be okay, because right now there's that unknown that's causing so much fear and panic. But the moment that can come in, there'll be some normalization, and that normalization will start to spill into markets such as real estate. And back into doing what you and I do, if people aren't fearful that the end of the world is happening, which if you turn on certain news networks, they're spelling that. Like you said, it's doom and gloom. The end of the world is here. It's just a matter of time, and whose fault is it and whatnot. And we don't have to get into that. But, if we depart from that and just kind of remain optimistic and put our faith and backing and support behind everyone in the medical field, and remain optimistic that they're going to come up with some solutions here. It's just a matter of time. And once they do, that's going to inject a lot more confidence into certain areas, and things will calm, and we'll come into our new normal of whatever that is. And I think social distancing, how it pertains to real estate, a lot more Zoom collaborations like what you and I are doing, and people doing these things, which are fine and healthy, are going to become the new standard. And virtual tours may continue, or a socially distanced tour. And, open houses, those dynamics might change. I think on our side on lending, because so much of it is interactive anyways of that whole process. You know, that'll continue on. I think your world will change a little bit, but we'll be able to get back to a new business as usual, you know, as soon as that happens. So that's my crystal ball, buddy, is that my faith and you know, support is behind, and fingers are crossed for the medical community to come up with something, and they will. I think you and I have talked about this. We feel good and optimistic that they will.
Yeah, for sure. Cool, man. Well, thank you so much. I appreciate you doing this again.
Yeah, I appreciate you, brother. Keep doing what you're doing out there, man, and like being the calm in the storm. You know, there's a lot of people, like we talked about, that are throwing gas on that panic fire, but you're definitely not one of those guys, and I appreciate you for that, man.
Thank you, man. Thank you. I appreciate it.